We are pleased this morning, Becky, to be joined by Beth Hammack, the new Cleveland Federal Reserve Bank president, ex of Goldman and all kinds of fun things. Welcome, your first television interview. Welcome to the conversation, I'd like to say.
Thanks for having me.
So let's start right away. Let's get into it. The morning the durable goods number came out, up 0.1% on the investment side. What are you hearing about how the change of policy is affecting the companies in the context you're talking to?
Well, thanks for having me, Steve. It's great to be here. One of my favorite parts of the job of being Cleveland Fed president is going out in the district and talking to companies, talking to businesses and understanding how they're thinking about things. What we're hearing right now is that the uncertainty is really weighing on businesses, and it's creating issues for them in terms of planning, in terms of thinking about where they're going to go. And so some of them have put pauses on whether they're going to make bigger investments, whether they're going to invest in new facilities, new capital plans. And then they're thinking about their hiring plans. They're thinking about their labor force, and do they have the people they need? How many people are they going to be able to keep on for what length of time, given what these changes might do for their businesses?
What is the macro effect of this? If people hold back now, what does that mean for the economy now, and what does it mean for the economy in the future?
It's a great question. We don't know the answer to that. I wish I had a crystal ball. We don't have one. I think everyone is trying to work through what the implications of these tariffs and these policies are going to be, how significant the tariffs are going to be, how long they're going to stay in place. And if you're looking at building a new facility, building a new plant because you want to bring back production into the U.S., you need to have confidence that those policies are going to be in place for a long period of time. It can't just be 2 or 4 years. It's got to be 10, 20, 30 years to get that capital investment to make sense.
When you put it all together, there are people, Torsten Slok from Apollo, other J.P. Morgan as well. They say if these policies stay in place, there are 60, 70, 80, Torsten's even 90% chance of recession. What's your outlook?
I'm not really operating with a base case right now. I think the cone of possibilities is so wide.
When you say base case, that means you have no sort of odds-on bet in what you think.
I'm looking at scenarios.
Right.
I'm trying to break the world into different scenarios of what could happen. If we see businesses really start taking the tariffs and it impacts their input costs and they have to raise prices significantly. If we see pricing going up a lot, but we don't see an impact on growth or labor, then that could be, inflationary. But it could be, like one of my colleagues says, that the tariffs could be just a change in the price level and that it's not going to be persistent. And it could be that we see actual, weakening in the labor force, weakening in growth, and that would require a different set of policies. And it could be that we have the two sides of our mandate in conflict, which is the most challenging for monetary policy. If we see higher inflation and lower employment, that's where things get really complicated.
How long do you think it will take you to kind of suss out which one is the more important? Because my guess would be that you'll have someone in the Oval Office who is watching very closely when you all meet next month to see what happens. Is it crazy to think that it's too soon, or is it crazy to think that a decision could be made by that point, that you will say, okay, we know enough about what's happening here?
So I think it's too soon. I think we need to be patient. I think this is a time when we want to make sure we're moving in the right direction than moving too quickly in the wrong direction. And so I would rather take our time, make sure we're looking at the data. The hard data that we've come into this quarter with are actually really good. Right. You've got unemployment right around 4.2%. That's right around full employment. Inflation's continuing to come down, right around 2.5% on PCE. So we've seen good things in the hard data. The soft data is more concerning. A lot of the surveys have shown more worrisome, more struggling with, exactly what things are going to mean. We're seeing that in the Beige Book that came out yesterday. You're hearing a lot of focus on tariffs and uncertainty. And so, to me, this is a good moment for us to take our time and make sure we're moving in the right direction. You've seen that this is not a Fed that's afraid of moving quickly if we need to move quickly. And so if we have clear and convincing evidence by June, July, September.
But afraid to move preemptively. That's the thing. And I know how hard it is, but saying I want to wait and see. Let's say the tariffs, and we've seen when the stock market acts a certain way, it seems like the tariffs become less certain that they're going to be here for a long time. So on the one hand, you say that you might not get to the second derivative. It might be a one-shot deal. We might not even get the one-shot deal. We might not even get that. But we do seem to have a lot of uncertainty. I think I can already say I think the risk has shifted much more to a growth risk than inflation. We had some really soft inflation numbers already. If you really want to be preemptive and be the greatest Fed in history to actually anticipate something instead of reacting to it, you would cut soon. Did I convince you? You're going to vote for a cut?
I'm not voting this year, so it's an easy year for me.
Next year, then, right?
Next year we're voting again. Look, I think the Fed has proven that it can be preemptive, and it will be preemptive when it's clear what the right action is.
When did they prove that?
In 2020. I think in 2020, when you saw the onset of the pandemic.
Inflation, though. Oh, okay.
When you saw the onset of the pandemic,
stayed too long.
Perhaps that is a viewpoint, but I think when it's clear which way the economy is going, that's a good moment for the Fed to be preemptive.
So what would be the flashing red signals? What would you look to? Is it the stock market? Is it, or what are the indicators that you watch most closely to think, okay, here's telling me what the real heartbeat of the country is?
Yeah, it's really in the real data. I mean, the stock market, I grew up in the market, so I pay attention to the markets, but I pay attention to the markets now because of what the impact they're going to have on individuals and businesses and those signals that they're going to take. So as a policymaker, it's really more about how do the markets impact the real economy rather than the markets themselves.
So, but what real economic numbers are the hard data that you're watching? What's one or two or three numbers that would be the most flashing?
I mean, unemployment
signs?
we look at, the PCE numbers, the CPI. I mean, all the big indicators are ones that we look at.
But those take a while.
Those take a while. Well, you can look at other things like shipments that are coming in that are kind of faster, more real-time indicators. There are a few of those that we can try to track.
One of the things I know that you watch are what's happening inside the financial plumbing. And that was one of the things that I guess that's how I first got to know you, was in the middle of the great financial crisis as you stewarded Goldman through some of that, or helped steward Goldman through some of that craziness. What did the last couple of weeks look like to you?
So again, I'm a policymaker. I'm not a market participant, but I did have a number of conversations. You know, my staff and I, we try to reach out.
There
and
were
make
things
sure
you couldn't help from
things.
looking at the time.
Yeah, I mean,
how did it look? Did it look like there were issues out there in terms of the plumbing? Were things clearing in a way that were not clearing in a way that made you nervous?
It looked like there was a lot of volatility in the markets, and anytime you have a lot of volatility, position sizes need to come down. Because if you have a position of this size with this kind of volatility, when you have this kind of volatility, all of a sudden the risk that's in that position is so much greater. And so you need to adjust your position. So again, not a market participant, but from what I saw at the time, what was happening was people trying to reduce their positions, trying to pare things back to get to a more reasonable level, given the volatility in the market. And things were moving, things were transferring. And that's what you want to see in a healthy market, is you want to see that risk transfer can happen. And I think we did see that. I think it felt, it felt like a big shift from where it had been a few weeks before. But I think in line with the level of volatility we were seeing, that was solid market.
Some people are still arguing we're restrictive. Some pretty well thought of people based on where the 2-year is. I used to think we were restrictive, and then we'd get a Friday jobs report, and it's like, oh my God, it was just the little engine that could.
We are a very resilient economy.
Is it still like that? Do you think that all this hand wringing with the growth worries every first Friday of the month, we're going to say not yet, and then we wouldn't be too restrictive. We'd probably be just right.
Again, this is why I'm thinking in scenarios rather than a base case, because I think there are a lot of different ways that we can go from here. One of the things that we hear about the labor market from people that we talk to in the districts is there is this hangover from the pandemic where businesses really don't want to let their employees go because they were so hard to find. It took them so long to train them and develop them that they are really holding on to them as much as they can. And that may help support the labor market as we're moving forward.
When you think about having the clarity you need to make a decision on policy, today was a really good example. You had this massive surge in aircraft parts. It was up like 139%, which tells you this month's data is not telling you what's happening in the economy. Next month's data will probably be a snapback from that. But thinking through the inflation numbers, we haven't really seen it show up, any tariffs show up in the inflation numbers yet. They may not. The market is priced for a June rate cut. Do you feel like you could have the clarity on the inflation outlook in June to make a decision?
I think we'll be watching the data carefully, and I enter every meeting with an open mind about whether it's a time that we should be continuing to be patient or a time that we should take action. And so if we have clear and convincing data by June, then I think you'll see the committee move if we know which way is the right way to move at that point in time.
I like you. I like how you answer your questions. I like how you're coming at this. You don't have a set perspective. You're going to be watching the data. You are data dependent, it sounds like.
I think that's our jobs, right? My job when I walk in that room is to make sure that we're doing our best for the American people, that we're looking to really try to support maximum employment and price stability. That's the goal. That's what every one of us who walks in and sits around that table.
It's impossible, but it's a good goal.
One thing you said last night I think is important. You talked about this idea. The Fed's job is not to set the term premium. So let's turn that into English for people, which I think, tell me if I'm wrong, it means the bond market's going to go where the bond market's going to go. We take care of the inflation component of that. It takes care of how much it wants to place on the cost of duration. That wasn't even better English, was it? Is that fair to say? Explain what that means, though, for people, and how that really it animates Fed policy.
Well, what I was trying to focus on is our job is to focus on setting the level of easiness or restrictiveness of monetary policy so that we're steering the economy in the way. The markets are this other force, and they tend to be very forward-looking, very reactive, very quick in terms of how they're responding to things. And they want to factor in, what's the net technicals of buyers and sellers? What are some of the broader flows? What's the risk premium, as you said, on these longer rates? And that's what that's bringing into it.
Do you worry about this idea of sell America, that the dollar was weaker, the bonds were weaker, and stocks sold off at the same time?
It's certainly an unusual pattern of movements to have all together, and so it is something that bears watching. I think what you have to remember is that when I talk to market participants, they tell me that many funds have been well overweight the U.S. relative to where they would have been, and so what some of this could be is more bringing just things in line rather than a broader theme. Sure. But these are things that are worth
a slightly different, Fed independence question, which is, the president's back down on firing Jay for now, but he's still making these comments. It wouldn't shock me if you start to hear rumblings in the fall, or I don't know when, about whoever his next Fed chair is. And Scott Bessent, before the election, talked about having the shadow Fed chair, and this idea that the market is somehow going to disregard whatever the Fed is actually doing and look through that because of this new person who would emerge. I'm curious if you would just react to that and how you think that plays out in practice if it does.
Again, that's a great question for a market participant. As a policymaker, we're going to focus on the data. We're going to focus on what's happening in the real economy. And we're going to try to keep our noise-canceling headphones in and stay focused on the underlying realities of what's going on, and try to ignore to the best that we can
the noise. To some degree, I imagine the noise, you are having to react to the noise is part of the data. I mean,
if it flows into the data, then yes, we need to react to that.
Well, I guess my question, I know you're not a market participant. Do you think it could flow into the data? That's the question, right?
It's entirely possible that it could flow into the data. I think you've seen in the markets recently that depending on what the president is saying about the chair and how he's positioning it, that's having an impact on markets. And so it could be that if there was some other scenario, that could have an impact on markets. But again, our job is not to focus on what the markets are doing. Our job is to focus on how that's going to impact households and businesses and what that's going to mean in the real economy. And so we're not steering the markets, we're steering the real economy.
When you join the Fed, do they give you a pair of noise-canceling headphones? Is that part of standard issue?
I mean, maybe it should be. I don't know. That would be good.
But actually, seriously, when you saw the market react to that issue, what did it tell you about what the market thinks about the importance of Fed independence?
I mean, again, I'm really trying not to channel my market participant days because I really am a policymaker now, and that's how I'm approaching things. And I think what you see, and there's a huge body of literature that says countries with independent central banks tend to have better economic outcomes for their communities. They have lower inflation, they have more stable employment, and I think that's what you're seeing in the markets is that view that's backed up by the literature that says independent central banks are good for economies.
Beth, I want to thank you for coming in today and for joining our conversation here about all this stuff.